In today's video, we're going to discuss 6 things you should do to prepare yourself for a housing market crash. Because there are a few things that many of us know about the housing market as a whole. Over a long enough period, yes, house prices tend to rise in most areas. But along the way, after many years, they also do have a little wobble and either correct or crash, depending of course on how you choose to see it. But let's rewind for a moment and take a quick look back into time to give a little context to the 6 tips I will be sharing with you in a moment. Now, if you look at the US, there's been multiple occasions where this has been true. We have seen, or at least read about, the panic of 1837, the 1873 stock market crisis, the 1929 Wall Street crash, Great Depression of the 1930s to 1940s, and of course, the 2008 housing bubble, which some of us actually lived through. And it wasn't a great time. But as I mentioned previously, we also have the infamous 18-year housing cycle, which was made famous by Fred Harrison, who accurately predicted the 1990 and 2008 property market crashes. So he's a lot more accurate than many of us on YouTube. Now, the reason this is an important thing to know is that it explains how market cycles work and highlights the ups and downs of property economics. You see, you have a recovery phase, the mid-cycle dip, the boom phase, the winner's curse, which essentially comes at the end of the boom, and then the crash or recessionary phase. And the question on your lips now may be, well, where exactly are we right now? Well, we could well be closer to the winner's curse of the 18-year property cycle than you think, which means buyers are still prepared to pay as much as they were during the boom years, even when the market conditions on a whole are generally worsening. Now, with that brief history lesson over, which hopefully gives some insight into the economic cycles and realizing that the housing market does indeed operate within one, let's look at 6 points I want to share with you guys that hopefully help you for 2024 and 2025. The first point is portfolio reassessment. I know there are many people out there who believe house prices will rise forever or double every 10 years, and believe videos like the one I'm sharing today may perhaps be scaremongering. But as much as I would love that to happen, at least for my own portfolio as well, I am also not naive enough to ignore the macroeconomics of the world today and the cycles we just touched on, and therefore I think it's extremely important to reassess your portfolios. It's the first time since investing in 11 years that I haven't taken money out of any of my properties when it comes to refinancing, despite them growing in capital appreciation. Usually I refinance and take some cash out to expand my portfolio or utilize it elsewhere. But in the past 18 months or so, I've been letting my loan to value drop and increasing my equity within those properties. The reason for this is because I always knew, not because I'm a genius by the way, but I always knew that the interest rates that we were seeing in the pandemic, those low ones, wouldn't be around forever. And fast forward to today, I am glad I did so, because larger mortgages, as you likely know, means less cash flow, even despite the rents rising. So please don't over leverage and really start to stress test your own portfolios, taking into account maintenance costs, which are of course increasing, higher mortgages upon refinances, and just ride this next phase out, because I don't want to see you fail over the next year. The second point is to think like an investor, unless of course homes under the hammer is your thing and you love to flip properties. But when investing, it's all about delayed gratification and really thinking about the long term and then working backwards. Now, although cash flow is great and if done well helps, because let's face it friends, the cost of everything sucks right now and it's unlikely to improve anytime soon, so cash flow helps. But the real wealth is made in capital appreciation. I would argue you will make more money if you bought in the right place through capital appreciation than you would when compared with cash flow. And that's why I generally tend to stay away from really cheap areas where rental income is low. So when you invest and you know your ROI and you factored in the risks over a long enough period of time, thinking long term, in my opinion, definitely wins over the short term profits. And I say this because it's easy to get disheartened when rates rise and your money is cut in half because your mortgage bill is now double. I've had it on a few properties, but thankfully they've also risen a fair bit in their valuation, which for myself is fine. I'm happy knowing the value of my cash is rising in bricks and mortar rather than with banks, which I'm not a fan of. Point 3, speak to a broker. Before you are coming up for a refinance, it's very important to speak to your broker. The beauty of this is that they can give you some indication of what rates you could be getting, but also lock in rates too, if a specific lender has a special deal, for example, or if they're lower in that month. And the beautiful thing with this is, if rates do improve and become more favorable over the long term, you can also switch to them seamlessly. And I've literally just done this a few months ago on one of my buy-to-lets. Point 4, increase rents. Now, this may irk a few people watching this, but hey, it has to be said. I've had my rent increased on me many times, and for the first time in 11 years, I actually had to increase my rent on a lovely tenant of mine. Now I'll run through this in a landlord video which I have coming out, which will share some of the problems I've had over the past few years, which have actually cost me thousands and thousands, which I'd hate for you guys to go through. So subscribe and tune in for that one. But rents are rising in most areas, and it's important to keep those in line with market rents. Don't just increase your rents to random figures, however, and also do take a common sense approach with your tenants. For example, I have many great tenants who have never caused me any problems, and as a result of that, I've never really even thought about increasing the rents for them. I'm not saying you should do that, because maybe you should think a bit more like a businessman, but hey, I simply haven't. Anyways, I recently increased one of the rents with one of my tenants, and it still sits below the market value by about £100 per month. And technically I could be cheeky and show them the market rents and demand the actual figure that it should be renting for. But I'm also not harsh enough to put someone in that situation where they're needing to fork out so much extra a month just because of the demand in that area. Some would argue I'm stupid for that, but I'm not going to do it. I don't want to do that to them, and thankfully I also don't need to do that to them, even despite my mortgage currently rising. But the key here is to not let yourself drown and stay up to date with the market trends, and not just be a pushover in terms of getting what you could actually get for the service that you provide. However, please be mindful, unless otherwise stated in the AST, you can't just willy-nilly, that's a technical term for whenever you want, increase them throughout the year as and when you please. Be transparent with your tenants and do it the right way. Point 5. Now this is in case you haven't bought a property. So the first few points were more around those already with assets under their name. I always get the age-old question, should I wait to buy a property or not? Now the quick answer is it depends, and I could make a video for hours depending on your current situation about what you should do. It all depends on your goals, the return on investment, if you're happy with that, and your desired outcome with the cash that you're willing to part with. But what I will say is when markets correct and crash, that is where the real money is made. Although it may not seem it, but that's how millionaires are made. That is why the richest people I know, at least, are sitting on their hands somewhat, which is hard. It's hard to sit on money with inflation and poor interest rates being offered on savings. And it's also difficult to predict when exactly to time the market and the exact drop, especially as property doesn't tend to drop over a weekend or a week. But as I mentioned in many of my regular update videos, more and more people are falling into arrears, and as refinances rack up and costs rise for homeowners, there may well be many opportunities out there for people to get themselves a property below market value. Point 6. Think outside the box. Now one thing with property is there are many ways to skin a cat. Something I've learned from investing for over 10 years. Buy-to-lets, although seen as the bread and butter of investing and a proven reliable strategy over the years, there are other things you can do too. I have experience in HMOs, commercial conversions, new builds, service apartments, title splits, planning, all that sort of stuff. And sometimes, I'll be honest, they can be so much more lucrative with a lot less stress. Well, sometimes. But friends, for the past 12 months, personally, I haven't bought a single property, despite being offered some with reasonable ROIs. And if you want to know why, then stay tuned for next week's video.